Okay, I've got 6 o'clock here, so I want to keep people on time. Promise I'll be done well prior to an hour, so don't worry, you won't be held hostage for an extended period of time. My name is Bryant Sikorsky. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. I've been in the financial services industry for about 19 years, independent for the last 9, and previously I'd worked with Merrill Lynch and Edward Jones. I help individuals and small business owners, as they say, make good decisions with their money, and that can include things like financial planning, investment management, access to insurance, and then any of those other kind of financial questions and decisions that are going to come up over the horizon, like when to apply for Social Security, how to apply for Medicare, et cetera. Now, as an independent financial advisor, since we are in a regulated industry, we are obligated to register or have ourselves registered, if you will, with a broker dealer. And my broker dealer, even though my company that I go by is Stratos Wealth Partners, my broker dealer is LPL Financial. LPL Financial is a little bit like a professional version of E-Trade or Scottrade, plus they provide a lot of research and background information, one of which being this presentation today. They come out at least twice a year with kind of outlook for the year and outlook for the remaining of the year after 6 months market and economic review. So I am going to go through this. It's about 19, I want to say, pages, so not too bad. And then I do have a little bit of a thumbnail publication that they put out entitled Election Preview, Biden Presidency, Upsides and Risks. And this was actually put together prior to the election. So, you know, at the time they were saying, you know, if Biden wins, here's the good and the bad, and they had one for Trump. So I thought I'd go through the high-low, if you will, about Biden administration. But first, let's kind of go through the kind of a touchstone to start off here with, just kind of where we're at. You know, we've seen 2020. I don't think anybody was hesitant to say goodbye to that year. We never have another one like it. And now we're looking forward to 2021. And in fact, our theme here is Outlook 2021, Powering Forward. And we're going to talk about the economy, post-election policy, and its environment. We're also going to talk about individual stocks and bonds. And in the background, we're going to cover some of the challenges, new opportunities, and the new way of doing things. And I think that one line there, the new way of doing things, is really key because we can see that there's been a lot of change in the way we conduct ourselves. There's kind of a whole new way. I mean, if you think about it, less than a year ago, no one had ever heard of Zoom as an example, and we're using it today for our video here, for our video conference. So if we think about and we look back at history, it's really kind of interesting. I, like most people, if I had never seen this before, would have thought that a Republican Congress would foretell a stronger stock market because of their focus on, lower taxes, lower regulation, a little more focus on the corporate sector. But that's actually not true. A split Congress has actually been the best. And although we do have a completely Democratic Congress at the moment, it's still pretty close. The Republicans picked up quite a few House seats, although the Democrats still have majority. And then on the Senate side, it's a 50-50 with the vice president being the tiebreaker. But even in that 50-50, there's some, some little capsules and some little affiliations going on there. So it's not like each of these components of the House are, all singing Kumbaya together. So we think about the U.S. economy, it was actually improving and growing very nicely early in 2020 after a modest slowdown in the fourth quarter of 2019, and then it skidded to an abrupt stop in the face of COVID-19. And I guess the tragedy of tragedies is that if you really come down to it, therefore, this recession that we're pulling out of, which is good, but really the recession was caused mainly by the government closing businesses and people staying home in response to COVID-19. Now, once the economy began to shift into gear again later on in 2020, and this is key, a new economic expansion has likely begun. And why that's important, we'll see on this next slide, is because we can see where these are showing us a new expansion here where it says summer of 2020 at the very right-hand side. We've got all of this record amounts of monetary and fiscal stimulus in place. And we've got a vaccine that's being administered right now. So as this chart shows, the average length of an economic expansion has historically been about 5.5 years. So the one that ended in 2000, the most recent one that ended, it started in July and ended kind of in July about 10 years or 11 years later. So we can see that it was very brief. Brief in its cessation. So it ran for about 11 years, and then just for 6 months, we were in a recession. And now, mathematically speaking, we've already pulled out of a recession at the moment. And unfortunately, as I say, those you can only tell if you're in a recession after you've been through one. So you can only kind of calculate it in a rearward fashion, I guess. Now, what this shows us is that, unfortunately, and this is nothing that we didn't all know, but the real pain incurred, has been characterized by kind of two different types of recovery. We got the services part of the economy hampered by restrictions, while manufacturing and goods production have moved forward at record speed. So we've got this, what they call the K-shaped recovery. And the K-shaped recovery has one part pointing higher or improving, while the other part is pointing lower or deteriorating. And without a doubt, we know that small businesses and the service industry, restaurants, hotels, et cetera, have really taken a beating. And this chart shows us that while the high wage unemployment rate since this past February has been actually, improved, it's really the low wage unemployment rate, those earning less than $27,000 a year, that have really, really, really suffered. So we can see, again, the low wage unemployment was back in February was actually, mathematically zero, but you can see where it pumped up there to almost like 13 or 14%. So the shutdowns, which caused so much rancor, I guess you can see why this is they went from 0% unemployment to almost 15% in the period of 2 to 3 months, and that was just devastating. So now we've had continued progress in the response to COVID-19, including further stimulus, and these are going to be key to sustaining the recovery. And I'm going to get back to that a little bit at the end. You'll see why. We expect some of the accelerated innovation that came with COVID-19 response to have a positive long-term impact. And as the pandemic subsides, restrictions are lifted, and consumers' daily lives return to anything resembling normal, the pace of the recovery should pick up speed. And we expect this to occur kind of mid-2021, which is only about 3-4 months away, fueling above average growth for the full year. And we forecast between 4 and 4.5% gross domestic product growth for 2021. And emerging market economies are going to be the leaders in this global rebound. And we believe growth in the international developed economies are going to lag behind the United States, like Europe. Whereas we see forecast global growth overall to be 4.5 to 5%, actually a little bit higher than the US. Inflationary pressure is likely to remain limited, and the Federal Reserve, or Fed, is expected to continue to keep rates low. So you start to hear a little bit of a pattern here. You know, we've got stimulus, continuing stimulus packages. We've got the Federal Reserve keeping interest rates at near 0%. And as we come to a couple more slides, you'll see what a larger impact that has to things as well. So many of us might say that 2020 was one of the most difficult years we've experienced. It was the worst pandemic in over 100 years. We had a deep but very brief recession and a bear market following that close by. We had incredible election uncertainty, and yet 2020, if you believe it or not, has been a good year for the stock market. Because again, the market is forward looking. So as bad as 2020 was, stocks are likely looking ahead to even better times in 2021. So a strong earnings rebound in 2021 may allow stocks to grow into somewhat elevated valuations. And what we mean by valuations is essentially a division of the share price of the stock divided by the outstanding earnings per share. And that number, that if I call it valuation, doesn't mean anything in of itself. What it means, what it is, a relativistic number. So when stocks get above a PE ratio or an EPS number above a standard, then the stocks are considered expensive. If they're below that, they're considered cheap. So it's just kind of a thing saying, well, wait a minute, you know, if we've got a high stock market, does that mean that we're headed for a pullback? So as the threat of COVID-19 diminishes and the economy moves towards fully reopening, we anticipate corporate America will begin to showcase its much improved earnings potential. And we estimate $165 earnings per share for 2021. You can see in the chart here that for last year, it was only 133. So that's a pretty significant jump. And we see the US Treasury yield finishing 2021 in a range of 1.25 to 1.75%. And so what that tells you is that, you know, any type of interest that you're going to earn off of a bond we're going to talk about that in a bit, is going to be pretty darn low. And in fact, it's, you know, I'm not alone in saying this, but I'm of the opinion that a number of people are in the stock market are there not because they want to, but because they've got no choice. So if I, you know, for years and years and years, financial planning modules would calculate that you could earn, you know, 4 to 5% on your money in safe, quote, safe bonds in your retirement. Well, now what are we looking at here? 1.25%, maybe 2% on a corporate bond. So if you've been planning your retirement on earning 4 to 5% in your retirement to generate income, and you're really getting 2 or 3, well, how are you going to make up that difference? Well, you either don't retire, you spend less in retirement, or you get into the stock market, because that's the only place you can go to get returns above, pick a number these days, around 6, anything above 5 or 6%. If you're getting as much as 5 or 6% yield on a bond, that bond is just about as, if not more, quote, risky than a stock at this point in the economy. This is kind of interesting. This shows us that new bull markets have historically built on strong first-year gains. So if we look at this, it says that in 2020, the S&P 500 index was able to fully recover its bear market decline in only 6 months. And this typically takes years. I mean, I think back to the 2008, Great Recession. It took over 10 years to completely recover. Here it was 6 months. And in fact, for the first time ever, stocks are in a position to produce a gain in a calendar year after being down by more than 30% at any point during that year. So after such a strong rally from the March 2020 lows, it'd be logical to think that returns going forward may be more muted. In this chart, we look at some of the previous major bear market lows, and we see that stocks tended to add gains well after the initial surge. So the little blue sections show us what kind of performance we had after 1 year, but the orange shows us what we experienced 2 years after. So it's not like we just had a 1 year improvement. That improvement proved to be resilient and to continue on. Now we're looking at corporate earnings. They fell, no big surprise, I would say. They fell very sharply in 2020 due to the lockdowns and recessions. And despite lingering effects of COVID-19 in 2021, we expect the economic recovery to drive a big rebound in profits. And we potentially could see S&P earnings growth of 25% in 2021, boosted by cost efficiencies achieved during the pandemic. So again, we're seeing, stimulus, accommodative Federal Reserve policy of very, very low interest rates. We've got, the stock market improving. We've got COVID-19 vaccine. So again, why am I bringing this up? Is it, you might be scratching your head saying, well, gee, it sounds like he thinks the market's going to continue to improve. And from what everybody is telling me, it is. We are not going to see, unless something completely off everybody's radar screen, something happens that we're not anticipating. We're looking for the markets, the economy, markets, and individual investments to do quite well this year. Now, some of those areas that you might want to put down on your notepad going forward is, number one, what we call cyclical value stocks. Cyclical meaning that people will buy more or less of them if they have money to spend. And that's as opposed to staples, which are things you buy anyways, like food. Cyclicals are like, cars and motorcycles and boats. So with the continued improvement of COVID, continued stimulus, continued low rates, that means that cyclical value meaning kind of trading at a discount. So maybe something, I'll use this as a crazy example, but a motorhome. You've always wanted a motorhome, and it's been depressed the last year because of COVID. Now is a great time to own motorhome stock. Another one would be small companies. They call them small cap or small companies. Yes to technology, without a doubt. Technology is, love it or hate it, it's still a huge profitable empire at the moment. Not too crazy about some of their policies. Yes to industrials and materials, and yes to healthcare. Industrials and materials, because although the Trump administration had pounded the drum quite strongly about infrastructure spending, they did that, but then they got into kind of a trade war with Mexico and to a lesser extent Canada, and then without a doubt China, so that there was not the money available to undertake infrastructure. The Democrats are saying, oh, we got it covered this time. So it'll be interesting to see if they are going to, fix the roads, fix the bridges as they promise they're going to. And we would say, again, no to consumer staples, stocks of cereal companies, I guess, or diapers. and kind of a no to utilities, because those are considered defensive stocks. Those are stocks that are going to hold up well during a volatile market. During a market downturn, we're seeing a market upturn. And most definitely, again, we're still advocating emerging markets. And in particular, we should take a good look at Japan right now. They themselves are implementing some programs to improve their overall economy as well. So they would be a good one to take a peek at. So the economy may be kicking back into gear, kind of potentially providing a tailwind for stocks, but the story isn't the same for investment grade bonds. An improving economy generally leads to higher interest rates, and when rates go up, bond prices go down, weighing on bonds' overall total returns. There'll still be opportunities for bonds in 2021, but it may be a year that requires much more patience, much lowered expectations, and a much more opportunistic approach. The inflationary pressures are likely to be limited, and the Federal Reserve is expected to keep rates low, but economic improvement and even normalizing inflation could put upward pressure on rates. So you may have seen in the news or heard on the news, what's the number one investment that people are buying these days? Is it stocks? No. Is it bonds? No. Actually, it's insurance, and not necessarily life insurance, but rather annuities. And if you've never looked at an annuity, it's essentially buying investments from an insurance company instead of buying them from a mutual fund company or buying them on the market yourself. Why would you care about that? Well, annuities provide certain guarantees that you can't get or don't get from stocks or bonds or mutual funds, such as a lifetime income rider that allows you to make a withdrawal, say 5% of a fixed number for the rest of your life, regardless of market performance. Or another one that I'm thinking of has a rider called the Guaranteed Principal Solutions rider. If you put money into that annuity, you can let it sit there for a while, and if things go great, you can leave it. But if you change your mind after 10 years, you can withdraw all your money. And if you've suffered any loss whatsoever, the insurance company will reimburse you. So you put in 100,000, it drops to 50. After 10 years, you get 100,000 back. You could also decide to withdraw 5% of this number for the rest of your life. So let's say that's $1,000. Even if the economy goes poorly and your portfolio declines, you still keep getting that 5% for the rest of your life. So if you haven't, again, annuities are not for everyone. They used to be quite expensive, but they've really gotten much more competitive. So whether you decide to buy one or decide not to buy one, it's imperative that you at least review it. I think it's just a good thing to kind of check off saying, hey, I reviewed it and either decided to buy it or decided not to. They've also got annuities now where you can tack on a long-term care insurance rider, which is very helpful sometimes. So the forecasted path of the 10-year Treasury yield, which kind of provides a baseline for our fixed income views, and we're targeting a 10-year Treasury yield of 1.25 to 1.75 by year-end 2021. And from a historical perspective, the large decline the 10-year Treasury yields experienced from the end of first quarter 2019 to the first quarter of 2020 points to a meaningful increase in yield. So since 1990, we've experienced 6 yield declines of at least 1.5% over 4 calendar quarters, as this chart shows. So in all 6 cases, the 10-year Treasury yield was higher a year later by an average of about just under 1%. So I think people are looking from some normalization to where maybe on a Treasury you could really get, say, 3%. But I think that's kind of wishful thinking, if you ask me. I just think that we're going to have too many stimulus programs coming out and too much of an accommodating Fed policy that I just don't see that happening yet. So the next thing I've got is just this chart showing us that despite lower return expectations, high quality bonds may continue to play a role as a portfolio diversifier. Well, what does that mean? Again, it might only earn, a bond might earn 2%, but it kind of shows us here under the return heading. It says if you've got an S&P 500 index, it's down 15, 18, 12, 10, 19, or 33%, like we just saw this last year. The Barclays aggregate bond index, it's just a measure of a basket of bonds. You can see that they were at least mostly flat, if not positive. So people ask me, well, why would you have a bond in your portfolio today when the stock market's going so well? Well, I guess something could happen that could cause the S&P to drop 33% all over again. And at least if I had a treasury at that time, a treasury bond or a bill or a note or a mutual fund, at least I would have earned, 5%. So I've got something making 5%, while something else is losing between 10 and 33. So something to think about. So our journey still continues. And the other thing I wanted to take a look at or talk to you about is this other publication called the Election Preview, a Biden Presidency Upside and Risk. And before I forget, this presentation is being recorded, so I will upload it to my YouTube channel, and I'll show you where that is in a minute. And I'll also, so you can look at it there, and I'll also email each of you the program, if you will, that went along, or the booklet that went along with this presentation. So you've got that in hand, and I'll also include this Biden Presidency Upside and Risks. So the couple things that and that's this kind of presentation here, and the things that I walked away with are, it says, while there are risks associated with potentially higher taxes and increased regulation, and specific industries may experience a meaningful impact from policy shifts, for markets overall, there's a real possibility that it may be just business as usual. Now, let me read that again. This is just incredible that, all of that hand wringing and wailing and gnashing of teeth, there's telling us here that essentially, even though we've got, a Democratic president and a Democratic House and Senate, there's still the expectation that despite all this, it may just be business as usual. So, the world is not going to end despite what some of the voters may think one way or the other. It didn't end when Trump was elected, and it's not going to end now that Biden's been elected. Here's a couple of other things that I thought were really interesting. Is that one, if I told you that 10 out of 11 recessions since 1950 have begun under, would you say, Republican or Democrat presidents? Well, it's actually Republicans. 10 out of 11 recessions since 1950 have begun under Republican presidents. I bet you no one would get that right on Jeopardy. What to expect from Biden when it comes to taxes? Well, I've got a couple things here. This is while the Trump administration lowered the corporate tax rate from 35% all the way down to 21%, that had a pretty positive impact on earnings, and it really helped support the markets. A Biden administration may raise the statutory rate back up to 28%. But even if that happens, the rate would be lower than prior to the passage of the Tax Cut and Jobs Act of 2017. So I guess what they're saying is don't expect the Biden administration to jack it back up to 35%. It's probably going to be, kind of someplace in between the low and the high, and that's going to probably land at about 28%. There's also lesser known tax provisions that could potentially impact businesses' bottom lines, such as been talked about within the Biden administration is the where is it here? Oh, a minimum corporate income tax. We have a number of large corporations that essentially pay no tax at all because of our innately confusing tax policies. The Biden administration and this was also a Sanders wish, is to have at least some kind of minimum corporate income tax. Without additional business investment, the positive tax impacts on long-term business and economic growth was marginal, at least for the initial few years of the cuts. So this is going back to the Trump administration, particularly, again, it says that a Biden administration is unlikely to have so many significant confrontations with China and other countries. So, okay, maybe more higher taxes a little bit, maybe a little more regulation, but maybe less economic confrontation. Now, what to experience from a deregulation perspective? It says that deregulation was a clear priority for the Trump administration with a particular impact on the financial and energy sectors. However, that impact has not been reflective in the relative sector performance of the S&P 500. Now, it doesn't mean that deregulation wasn't supportive, only that the policy impact was smaller than those of broader economic forces. So, it was kind of the big picture that moved, not the little picture, if you will, the little sector. Let's see what else we have here on regulation. Immigration policy in the last few years has reduced labor flexibility for businesses and also reduced the average labor pool, particularly for specialized skills. Trade policy has caused large supply chain disruptions at high cost to many businesses, large and small. While this impact can't be completely reversed, the effect moving forward may be more manageable under a Biden administration. Now, a couple of industries that have been kind of targeted by the Biden administration or been, and whether it's perception or reality, I guess we'll see, is there's the expectation that the financial sector will experience much more significant regulations under Biden than it would have under Trump. And that's confusing to me because banks, well, maybe they tried but failed, but banks have historically been huge financial supporters of Biden. So we'll see what really happens. Oil and gas companies are under threat, if you want to call it that, and allegedly alternative energy is likely to be a priority for the Biden administration. Within initiatives and governance, we think that infrastructure will be an early priority for a Biden administration. And not only that, they'll use that potentially as an example of bipartisan collegiality, that they're going to get something, some kind of infrastructure, something done together, and then I'll sing Kumbaya afterwards. The President Trump was always criticized quite loud or critical quite loudly of the Treasury and the Federal Reserve, excuse me. And allegedly, this is supposed to be an independent institution. And Biden has pretty much said in so many words, the administration is that they will not be as combative with the Federal Reserve as Trump was. They will look to elevate it back to its independent status. And the Federal Reserve's objectives, if you look them up on Wikipedia, are to try to maintain that balance between inflation and unemployment. So we want to keep We want to get up to full, as close to full employment without triggering higher inflation, and vice versa. We want good rates on bonds, but we don't want them so high that we put people out of work. The other one that is kind of a sleeper here, I think, from the Biden administration, is going to be support for state and local governments. The Trump administration really didn't do much with municipalities, particularly cities. They just didn't like each other, and both parties suffered for it. The cities didn't get the money they had expected they'd get from Washington, and Trump didn't get the votes he thought he would get at the very end. So I guess it was a lose-lose for both of them. So with that, I'll say we foresee some market risks in the Biden presidency, but no more than we've already handled with an Obama presidency, which had a relatively strong stock market record. However, just as we argued that there's no real reason to sell stocks simply because of a Trump presidency 4 years ago, we don't see a particularly strong reason to fear a Biden presidency from a market perspective today. So I think it's more important that we have investments that we're comfortable with. If you are aggressive, then you can hold aggressive investments, but don't tell yourself, don't have your advisor evaluate you and tell you that you're a moderate investor and then turn around and say, I want to be aggressive, because you're not going to be happy. And vice versa. If you're a moderate investor and you get put into everything low risk, and we have a recovery like we had this past summer where the stock market went up 30% in just a few months, you're going to be saying, wait a minute, how come I'm sitting here holding this 5% return bag when my neighbor got 33? So I think don't waste your time chasing that elusive winner. Make sure that you and your advisor, or even just yourself, if you're working like online, make sure that you accurately and effectively know what kind of an investor you really are. That's going to make all the difference in the world. So like I said, I've got this presentation being recorded, and you can see this is my website, BryantSikorsky.com. And this is where you can learn more about me, and you can access your online account if you're a client. You can look at the things that I offer. You can see what kind of events I've got coming up and some additional resources. But you can see I also have a Facebook, LinkedIn, Twitter icons right here. And lastly, I've got one right there that says YouTube. And so if you click there, you will see my YouTube channel. And these are all the different videos that I put together. And this is one that I just put together back in September. So by next day or so, probably tomorrow, I'll have this recording uploaded onto the YouTube channel. So if you missed anything and you want to watch it again, it'll be there for you. And like I said, I'm going to email each of you that have attended here the workbook, if you will, that goes along with this presentation, and also that one, if you want to call it, white paper on the Biden administration and what to expect. So with that, I'll say thank you. 40 minutes didn't keep you hostage too long. Hope you learned a couple things. Again, my name is Bryant Sikorsky. I'm with Stratos Wealth Partners. You can reach me at my website here at 919-650-1527 or bsikorsky@stratoswp.com. And with that, I'll say thank you very much, and I hope you have a great evening.